Welcome to PhillipCapital's Weekly Market Watch. 2009 presented a lot of challenges for investors. So today, we invite Mr. James Chua, investment analyst from PhillipCapital Management, to tell us more. So James, how do you reflect on 2009 and the upcoming year ahead?
Yeah, 2009 was marked by the end of the financial crisis because of extremely large action on the part of central banks. Governments around the world pumped in incredible amounts of money to stimulate their economies when the crisis happened. And they did this in an extremely synchronized fashion, which actually was very effective, and it helped to end the crisis quickly. 2010 will be characterized as the end of this government stimulus. How the markets look like in 2010 depends generally how governments will be able to gently withdraw all this stimulus and to, so to speak, remove that walking stick. And of course, it depends on what economic growth looks like at that point in time.
What's your outlook for the economy and stocks in the new year?
Yeah, I'm expecting world GDP to grow 4% 2010, 2% in the US, 1.5% in the Eurozone, 6% in Asia. So you have this picture where growth is very different depending on what part of the world you look at. Really, the economic driver of 2010 will be central to what the Chinese are doing. So if the Chinese government decides that it wants to stimulate some more, then you see world growth going up. The story for stocks is good in 2010, but it's not fantastic. I'm expecting global stocks to rise 12%, mainly because analysts are extremely pessimistic about 2010 earnings. So you have a case where, because of 2009, analysts are very, very conservative about their estimates. So they start 2000 estimates on a very low level, and then what is likely to happen is that as companies go on reporting their actual earnings, analysts will play catch up and revise their estimates upwards gradually. So it really is a story of under-promise and over-deliver. One key factor to determine what the 2010 outlook will look like is the direction of PE ratios. Generally, in a year where risk appetite increases because of a friendly inflation picture and declining interest rates, you generally will see PE ratios rise. We don't expect that to be the case in 2010 because of headwind that investors must face with respect to central banks tightening. So PEs are expected to either remain flat or to decline. So we feel that any price upside in the market has to come from top-line growth, which is expected to grow gradually.
You mentioned you expect PE ratio to contract. Can you elaborate further?
Sure. When we look at PE ratios over a very long period of time, two things at the macro level generally cause PEs to expand. One of the things is a very, very benign inflation rate environment. So generally, when you have inflation between 1 and 3%, you can see PE ratios rise. The other thing, of course, is a very accommodative interest rate policy. So generally, when central banks drop their interest rates, PE ratios also have the habit of rising. The interest rates currently are very, very low, so that factor is crossed out. In terms of what inflation is doing at the moment, growth around the world for a lot of the CPIs is already between 1 and 3%. So if the inflation rate stays where it is right now, it doesn't act as an additional positive factor. If inflation goes above 3-4%, people start worrying about inflation, and that's a negative on PE expansion. So as a result, we don't think that PE ratios will expand in 2010. As mentioned before, any price upside should have to come from top-line growth, which we expect to grow moderately in 2010.
Thank you, James. That's all we have for you today. Tune in next week for more market updates.